Today, folks, there's no doubt about it, TD stock is getting absolutely devastated. They have been the bearer of bad news, from their analysts writing articles about the Canadian economy that is dire to the absolute insane money laundering, basically lawsuits that have been going on within the company itself. We're going to break down these details, take a look at the broader Canadian banking sector, and of course share with you where I think the best place to invest is when it comes to these banks. And if that is a conversation you'd appreciate, as always, hit that like button for you dividend-oriented investors, because these things are beasts. The yields are getting insane, and they continue to be insane. Let's be real. So TD right now is trading down 6% today alone. Year to date, 12.8%. Like, we're talking about a devastation wipeout. If we zoom out, let's just take a look at the 5-year, because from their all-time high, the stock is now down 30%. I mean, this is a full-blown correction crash, whatever you want to call it. It's been a slow burn, and the company just can't get ahead. This is the second largest company in Canada, and by the end of this video, I'm going to share with you whether this is a true buying opportunity or not. But it feels like they're going through a Wells Fargo moment, because Wells Fargo was doing a lot of manipulative stuff to get people to make bank accounts and a variety of other things. They ended up paying like hundreds of millions, I don't know, got into the billions of dollars worth of fines. The stock tanked 66%. But again, that proved to be a buying opportunity because this is one of the largest banks in the US. These banks do have really good survivability factors behind them. But let's talk about the two stories that are going on with TD that I find absolutely fascinating. First and foremost, TD Bank probed tied to laundering of illicit fentanyl profits, the Wall Street Journal reports. And then we also have an article that came out that says middle income families are poised to take the wind out of the economy's deflating sales, which is a fascinating title. So we have TD that's touting that the Canadian economy is really not that strong. And then we also have probing going on that it is claiming that, TD has been not responsible, but they've been a part of money laundering, basically probably not to their knowledge. So let's start with the money laundering, because this is just insane. But basically, TD is focused on how Chinese drug traffickers and crime groups use Canada's second largest lender to launder their money from fentanyl sales, the Wall Street Journal reported on Thursday. The bank disclosed last year that it was cooperating with authorities in an investigation into its anti-money laundering compliance program by the DOJ. So essentially, TD is following regulation to prevent money laundering, and there's holes in those regulations, right? And because there's holes, they're finding that there's been a lot of money laundering, and I don't want to say this is TD's fault, but the investigation was initiated after the agents uncovered an operation in New York and New Jersey that laundered hundreds of millions of dollars of proceeds from illicit narcotics through TD and other banks. So it's not just a TD problem. Basically, criminals constantly seek to use the banks to launder money. Regrettably, our U.S. AML program did not effectively thwart those activities. As previously disclosed, we have been and continue to cooperate with law enforcement and our regulators, and comprehensive effort is underway to strengthen our AML program, including investments in talents, tools, and technologies. So honestly, this could arguably be a drop in the bucket. Is this a big deal? Honestly, I don't think it is, because obviously other banks are tied into this. Somehow TD is getting the headlines because it's a conglomerate, obviously. And I don't know if the stock deserves to drop this much, because even if they have to pay back or they have to halt, even if it was like $500 million in trading value or like basically bank account value, I don't know how much that's materially going to hurt their bottom line. I'd be curious to find out. And if it did, it would be like a one-time impairment. If we were talking about billions of dollars, I might be a bit more concerned. But if this just equates to a couple $100 million, I don't think it's as impactful as the headline is probably making it out to be. But what is super concerning is this article. This article highlights that the distribution of household economic accounts revealed widening income disparities not seen since 2015, with the wealth gap expanding due to financial asset gains accruing predominantly to the wealthiest. Relative to pre-pandemic levels, an average household across the income distribution saw gains in both income and wealth. However, average personal disposable income for middle-income families have not kept the pace with the rising prices. Additionally, these families have become more indebted. Middle-income families have been the key driver of spending growth during the pandemic and are now facing greater liquidity constraints. Forced to economize their spending is likely to revert to historical norms, creating a drag on the growth. Meanwhile, spending of of the highest income earners will become a critical swing factor in determining the degree of economic resilience. And this is why we're seeing the liberals trying to implement new capital gain laws for those of the wealthiest to basically start paying more into taxes. Though I don't know if that's really helping the lower class to any extent, but this is a fascinating read that really breaks down that if you own real estate, this is primarily related to boomers, you have been disproportionately benefiting from the economy, even though we've seen a mild correction. Because you can see here the net worth or wealth picture is somewhat brighter, as all families were on average better off in 2023, achieving wealth gains of 1.8 to 2.8%. Higher income households benefited relatively more due to their larger holdings of financial assets, which were, obviously these are stocks, whatever, bonds, etc., GICs, were the main wealth driver last year. However, real estate assets, which from substantial portions of wealth for lower income quantities depreciated. This was exacerbated by a faster year-on-year increase in mortgage debt used to finance these assets compared to prior levels. Relative to pre-pandemic levels, an average household across the income distribution saw gains in both income and wealth. However, when compared to inflation, not all these gains kept pace. Notably, average personal disposable income for the second and third income quantiles were lower than the cumulative increase in CPI, suggesting that their real income is lower on average. However, relative gains in wealth were greater for lower income households, even when adjusted for inflation. This is especially true for gains in real estate wealth, where gains range from 29% for the highest income quantile for 50 to 56% for the lowest income quantile. Also, according to the Bank of Canada's research, real estate is the major contributing factor basically to wealth effects in Canada. So cumulative gains in this asset have likely supported consumer spending, which is insane to think about, because this article is just highlighting that middle class is getting wiped out, right? Like they're getting absolutely devastated, because if you look at the middle class that does own real estate, if they've owned it in the last decade, they benefited greatly, and that have made them more comfortable in spending money, living their lives. But the problem now is that disposable income for that middle to lower class hasn't equated to obviously inflation and other pressures, especially with new mortgage payments on their mortgages coming to renewal. But the upper class, people that likely own multiple pieces of real estate, investment real estate, they have a stock portfolio and all this stuff, they have been ripping past the lower class. And we've seen this, right? This is why you want to be an investor. This is why you want to live frugally. But this is scary, right? I mean, to start retracing back to 2015, it's a tough economic debate, whether we have to increase wages, which comes with other problems on the economy. Yeah, I don't know what the answer to this is. It's just a fact of reality that it's a trend that we don't want to see continuing, right? And I don't think taxing the rich is obviously the solution to that problem, as much as it is stabilizing the housing economy, which they can't do. Obviously, if they were able to build a bunch more houses and bring the cost of housing down, that's going to wipe out the entire boomers generation's retirement, right? Because the vast majority of Canadians' wealth is in real estate. We can't have that revert now. I feel like we're in this kind of tough situation where we don't want it to get worse, but we can't really have it getting better, because obviously if assets keep going up, it's only going to continue disproportionately benefit the wealthier Canadians. It's just a fine reminder that you need to look out for yourself and you need to work hard and don't rely on the government to fix this, right? Like now is a time to be frugal, invest, save. We're seeing it with Starbucks earnings. We're seeing how consumer spending is hurting general companies. So will the banks benefit largely from this? Of course. As mentioned, people are still surviving. The economy was going to crash. I don't think we're out of the possibility of a recession, but if it was going to crash, I think it would have already broke the camel's back with the current interest environment. But people are able to keep their jobs. The job market's strong. They're making the payments. So we're seeing banks here start to see the benefit, right? We've seen loan loss provisions slowly start to tamper away, which is what we're seeing in the US. I think we're likely to soon start seeing it in Canada as things start to nominalize and stabilize. And especially when we get to an interest rate cut cycle, I still think the banks will benefit from, because we're not going back to the interest rates we saw in the past, but it's likely we're going to see lower interest rates, but they're still higher than average. So the banks are going to benefit greatly from this, right? And that's going to start showing up, I think, probably by the latter half of this year, maybe by Q2, Q3 earnings is where we'll start seeing the benefit, perhaps, because we're already seeing it in the US banks. So it'll be neat to see toward the end of May when these banks start posting earnings if they start to benefit as well. But right now, you look at these banks and the yields they offer. Royal Bank has been coming back this year. Canadian Imperial has been flat. Bank of Nova Scotia has been flat. National Bank has been ripping. It's up 12%, all-time highs. BMO has been down. And it's not the prettiest picture across the banks, but if you are looking for income today, I think these banks still set up one of the greatest buying opportunities next to TD, because a lot of the current news that's tanked TD is materially unimpacting over the long term, in my humble opinion. And honestly, I'm still looking at these equal weight bank ETFs, which looks like this one got bought out because it used to be Horizons, but now it's Globex. So Horizons probably got bought out here. And we can see that this is my favorite bank ETF next to VDY, because VDY heavily weights the financial sector, with Royal Bank and TD making up about 24% of the ETF. But when you look at Globex here, this H Bank, HBNK is the ticker. This is beautiful because your performance since inception has actually been fairly stable. I mean, if we take a look at the year to date, it is actually slightly in the green, but what you really want is the yield, because the yield on this is now over 5%, and this ETF doesn't charge you any fees right now. They're not going to introduce a management fee until the summer, and that management fee, once it's introduced, is going to be 0.09%. That's lower than most ETFs out there, with a current distribution of 5.14%. So your average yield will be over 5% even with the management fee right now. What a beautiful way to start cost averaging to the banks and get that performance, especially when the recovery play starts to come around. It's not financial advice, it's just what I think is going to happen. But I'd love to know what you think. Do you think TD is going to recover from this? Do you think the financial sector is poised for a recession? I'm not playing the fear mongering game, because I'm always buying stocks, but I just love to know what you think about this.